Hey guys, good morning. This is Brian Jones. I'm here with Chris Hood, professional trader, world's most interesting man. Uh,
How are you?
Good. How are you doing, man?
Man, I tell you, lockdown again. I'm setting a record for this.
So you said I think we said that there's actually more cases. You guys have
Oh
got
man,
more cases.
it's crazy, Brian. I think it's this variants that are coming out,
Yeah.
and with all due respect to elected officials, I think the guys here have really butchered it. They haven't done a good job. I mean, 4 days ago they say no, we're not going to shut down the schools, and then 2 days afterwards, bang, they send a letter saying, oh yeah, we're shutting down the schools. I mean, it's not as if they had any change in information from 4 days ago. So the premier was throwing the mayors under the bus. He was saying, well, the mayors asked us to open up. I'm like,
No one wants to be responsible for anything.
no, I just hope that in the next election that we remember the damage that these idiots cause and we vote accordingly. And having said that, I don't think anyone could have done a good job. I really don't. But
Right.
when you look around the world and you see how good it's been handled in other places, you have to ask the question. So
Well, I don't know. I don't have much faith in elected officials, really. Any. It's
well,
like,
it's been a good 14 or 15 months since I choked someone out, and the gurgling sound or that snoring sound that you hear just before someone
right.
passes out, I've had withdrawal, and I'm really hoping that the politicians sign up to jiu-jitsu classes at the end of all of this, because I've got a couple on my list that I wouldn't mind choking out a little.
All
Anyway,
right, man. Yeah, I agree. Like that's something where just people have a short memory sometimes, and they vote on a party line instead of for actions. But you know how it goes.
ideologies are dangerous, man.
For
Anyway,
sure.
it's like, I used to have that with options. It's interesting. I used to have an ideology with options, and a lot of it came from, sorry, my glasses are really dirty this morning. Um, a lot of it came from reading books. Initially, a lot of people start off their options, training or whatever it is, by reading books. And the problem is with books, a lot of the information is static. So if you try and apply something from 1985 into a market like 2020, and the dynamics are different, you get a completely different result than what the book was describing, right? But you're doing everything that the book is telling you to do. And they were successful then, but you're not successful now.
Is
And
that why coaching is like in a like a
that's
daily
why I think
life?
you need someone with you, because many times I talk to people who started off their options journey by doing exactly what the books have said. They do it exactly the way the books have said, and they fail. And none of the books ever deal with the real-time emotional issues that come from trading. They don't do it. They deal with the technical aspects. And there's an assumption that, as rational human beings, we can look at something that's giving us contradictory information and react accordingly. But books don't help you deal with the emotional upheaval that comes from seeing a failure. And a lot of guys get sucked into it, and they get sucked in and spat out. And it's really sad when you hear these stories of guys who go in with all the good intention, and they go across and they watch a YouTube video, and then they buy a book from Amazon, and then they test it and they put it in and they win. Unfortunately, they win. And I mean unfortunately, because when the market rewards bad behavior, you misinterpret that as, oh, I should do it again. And then they do it again and again and again. And they might be rewarded maybe, 2/3 of the time. And then it's that one trade that wipes them out. And that's the sad part. That's the real sad part. So
Yeah, I think the failures, as I've been trading over the past year. I mean, I've definitely it's one of those things. It's definitely not a get rich quick
no,
scheme, and it's definitely takes a lot of practice. I'm still grinding away, kind of hammering out things and learning new stuff. So it's
this is, I think there's a false advertising. I think there's false advertising that comes down to this, is that you will have the one-off trades. You're going to have the trades like we had with Google last week. You're going to get that, right? but those are the exception, not the norm. The norm is every week you've got to grind out specific setups, specific trades. You've got to manage it. You've got to be consistent. And I think a lot of people in this modern age haven't got the discipline to stick with the rules that work. They're always looking for something better. And I was completely guilty of this in the initial years that I started. I became a bit of a junkie for, indicator this and set up that. And, if I was having a win rate of 72%, if I, spent another $10,000 coding something, could I get to 74%? And sometimes you've just got to take a step back and simplify things and actually go, you know what, if you can hit consistently 70% profitability on your trades with a profit ratio of 1.3, 1.4, and you can, manage your losses, so get out of bad trades early, you will be successful. Those are sort of like the sort of, the box you've got to play in. But I think a lot of retail guys get seduced by the GameStop environment. Can I make a quick 1,000%?
Well, it's exciting. It's one of the things. I think it's one of the things that draws people in, which is good in a way, because I think this is a useful skill. But then again, reality hits you in the face. It's like watching, the first year. It's watching the UFC, and you assume that with 6 months of jiu-jitsu you can beat anyone, and then exactly. You realize that it's not like that. It takes a little practice, but if you stick with it, you will get good. It just takes time.
Oh, perfect. It's like that Mike Tyson thing. It's like everyone has a game plan until you get punched in the face. And I think in option trading, the probability of you getting punched in the face is fairly high, especially if you don't know what you're doing. And that's why I think having someone next to you who might have already lost and can tell you, what, the last time I did that wasn't such a good idea. Or, I landed up doing that for 2 years, and you probably don't want to go down that path because it could suck you in for a long time. I think people, they need that. I think most people who want to be successful in the long haul need to make sure that their first couple of years are right. Because if you go, for the first 2-3 years and you're getting rewarded for bad behavior because the market is behaving in a particular way and you're not aware of it, so you're not even conscious of what it is that you're doing that's getting rewarded, and then the market turns on you and you keep doing what was working before, and now you're losing, and all the gains that you made going up the curve are now getting slowly eroded away or rapidly eroding away. I think that's the damaging thing, because if you look at any successful trader over time, they're going to have periods in 12 months that are going to have bad weeks, right? We know that. How many bad weeks did we have in 2020? I think we had about 4 losing weeks in 2020, but our income that we made was pretty consistent, right? Then in October, obviously the market seasonality starts to change. We start getting into that Christmas rally kind of thing. Our average income starts to increase significantly over that period. And then we were saying in November, you know what, guys, while the sun is shining, we got to make as much money as we can because February is going to be tough. We always know that February is going to be hard. What happened in February? A lot of people started to, don't worry, the market's always going to do this. It's always going to do that. Bang, they got hit. And everything that they made between November and January started to go backwards in February. March becomes hard. We now get the summer months. The strategies that you were using in the good times don't necessarily work the same way. They work, but the amount of effort required, your return on effort over the summer, is actually a lot more than what it was over Christmas. But people don't realize that, right? So they try and do the same thing over and over again. It's like, you give a white belt a triangle and you say to him, you know what, this is your go-to technique. You can't put the triangle on the guy if you're in turtle. You've got to get to the right position first before you can do it. And this is where I think a lot of people lose sight of the long-term game. The long-term game in options is consistency. It's just about being consistent. You're going to have bad days. You're going to have good days. You're going to have bad weeks. You're going to have bad months. You're going to have great months. It's being consistent over a long period of time. And if you work it out, one bad week, I see this a lot with people. They'll have 3 or 4 great weeks in a row. phenomenal. And their sort of personality at that time, oh, I'm really good at this. And then one bad trade. Oh man, and they go down into the absolute pits. And I always say to them, one bad trade doesn't make you a bad trader, as long as you understand why the trade didn't work. If you don't understand why the trade worked, and it was just this random thing that you got from your buddy at the gym, and it failed, and you lost $5,000, and now you don't know what to do, then you know what? That's all on you, because you shouldn't have done the trade in the first place, because you didn't know why you were doing it. You were doing it for a reason that sat outside of your rules. So it can be it's an emotional roller coaster for a lot of people. And they've just got to make sure, you got to understand the seasonality of things. You have to understand that certain trades are better than others. And if you follow the rules in the book, everyone is reading the same books. We see this, I'm going to share my screen and I'm going to show you a little thing. When people are trading and you see this kind of candlestick behavior on a stock, on an index or whatever, what this is crazy stuff. This is systems going out and hunting for people, because we all read the same books. We all put the same stop limits in, right? Everyone does it, all right? They read the book. It said, put your stop line at the previous low of this candle or whatever it is. The systems, when you put your order in with your broker, it goes into a file. It goes into sort of a trade log. Those orders are in the market, right? These systems will go out and hunt, and they'll see, oh, you know what? There's about 5,000 people that are willing to sell because your order's already in at this point. Let's go and push the price down to that point and flush them out. So you're at work. You've put your stop loss in. You're at work. You're like, man, this is fantastic. I've put my risk in. I'm happy to lose my 10%, right? I'm happy to lose my 10%. Well, you know what? You just got hit with that 10% loss because you were happy about it. And look what happened to them.
They were happy to take your 10%.
Absolutely. If you're willing to tell me that you want to go down to that place, there are people that will go there. And look what happened. If you were doing the SPY, you got flushed out here on this candle. You got flushed out on this candle. Bang, you're done. Look where the market ended. So if you bought the index and put yourself with a stop loss down here, you got hit. You came home that day. You've been at work. You go, oh, the market didn't do much today. Oh, it didn't do much. I should be okay. You log into your account. You're down 10% and the market didn't do anything. But you followed the rules. You went exactly and did what people told you to do in the books. This is why you've got to know what you're doing. And this is why a lot of people who trade don't understand the rules of the game. This is one of the rules of the game. You never tell people what you're willing to get out at. That's the first rule.
Like tipping your hand in poker.
Yeah, it's like going into a jiu-jitsu match and saying, you know what? I suck at the guard. I just suck. If you get into my guard, you could choke me from the guard. Could you imagine the advantage that the guy has now going, I don't care if I'm in your guard. I'm going to choke you out. You just told me what to do.
Right.
It's the stock trading equivalent of telling your opponent what you suck at. So,
yeah, I've noticed that. So I've been trading for a while, and it's been there's been some ups and downs, and I'm definitely having the perspective. When I came into it, I had the early misfortune of doing really well. Like when I say I did a whole bunch of really good trades, and I was overconfident and got smashed whenever the coronavirus thing hit last March. And I was back up, and I'm kind of doing this thing where I didn't fully learn my lesson on the March and February thing. So I took, I'm still up, but I took more losses than I should have. But I see what you mean about how it takes a year or so of perspective on things to really plan ahead. And, I listened, obviously I'm listening to what you're telling me. And there's something in your brain that it's like I have to get hit a few times before I learn a lesson, and I'm not going to stop. And I realized that because that process is there.
You know, the thing that most people want out of this is, and I put the blame pretty much on these Facebook ads and these YouTube videos and everything, where people, talk about it's a hack, it's 5 minutes, it's simple, it's easy, just do this. Because people look for the quick solution. People are really willing to, throw $20,000 down on a weekend course where, they're not going to earn that money back. There's a harsh reality to it. And most people look for, oh, well, if 3,000 people are telling me that's a good idea, then I'm just going to copy them. And you don't know what your trading personality is. You have no idea. You're just going to go blindly and follow these guys who might have already lost $500,000 and now they're trying something else, right? So, this is where I always say to people, paper trade for 30 days. Pick yourself a mentor or a coach and just follow them for 30 days with paper and see if it fits your personality, because we all have different trading personalities. Your reaction to a loss and my reaction to a loss are going to be completely different. I might look at it and go, I can tolerate a 1% loss if I've position sized it. You might have taken the same trade, put 10% of your account into it. And when that thing drops 5%, you're going to be feeling it a lot worse than me, but we're doing the same trade, right? So the thing is, paper trading, a lot of people with money to go, they're ready to start. A lot of people don't like doing paper trading because they feel like the trade of a lifetime is going to be missed, right? I can tell you now, the trade of a lifetime happens every day, every single day. There are trades, no matter what happens to the market, there are trades. There are opportunities, there are setups. The issue is you've got to restrain yourself from doing everything you see. This is not about going into a shop and just throwing your money at every single product on the shelf because you're scared you're going to miss out on the nice chocolate. You've got to sit back and say, why did I come into the shop? I came into the shop specifically to see this, this, and this. And if I can't find it in this shop, I'm going to go to the next shop. And the next shop might be the next day or the next week, whatever. And this is why creating watch lists and identifying opportunities that may appear doesn't mean you do all of them. All right. So, filtering the market down from 8,000 or 5,000 down into, 20. To me, that's the skill. The skill is getting identifying the area of the pond that is going to give you the fish that you're looking for. Because if you just go in and say, oh, well, I'm just going to fish from here and hope something bites, you might land up either having your line, broken completely, so you lose all your money because you picked the wrong thing, or you get no takers on what you're doing, right? So having someone with you or following a proven methodology, and this is the thing, there is no methodology that is foolproof or better than any other methodology. In my experience, I've seen methodologies that work that have got 8 to 9 criteria, and I've seen methodologies that work that have got 4 criteria. There's absolutely, the win rates would be exactly the same. It's the issue of your degree of comfort that you have with that methodology, right? So if I look at my methodology, I think I've got maybe 15 or 16 different things that I look at, but they're all weighted differently, right? So I put emphasis on certain things and I don't emphasize other things, but I like to know that they're there. So, I won't look at a trade. If I click on this graph, if I look at this trade, there are maybe 5 or 6 things here that are absolutely critical to me in a trade. Everything else becomes insignificant. And, one of the things I like to see is, I've got my little buying indicator, which is my green dot. That to me is a buying signal generated out of a Keltner channel, movements within a Keltner channel.
Is that some code that you've written? Or
yeah.
Okay.
So this was just for me to look at it and go, you know what? If the green dot is there, it's like a traffic light, right? So I look for 3 buying signals. This is my first primary level of a trade, is I've got the little green dot. There's some trades now, you'll see this little green arrow, right? The green arrow indicates a switch in the Keltner channel trend, right? So I like using the Keltner channels because most algorithms that trade within, price reversal systems operate with Keltner channels as the primary indicator, right? So when I see the Keltner channel indicator telling me, you know what, time to move up, I'm going to be looking at, that's my first indicator. There's my second indicator. So on this basis, I can already tell from just those two indicators, there's a potential trade here. Don't know yet if there is one, but just from there, from price action, there's a potential trade. I then use the squeeze indicator here to confirm that. So 1, 2, 3 indicators. Then I look up at the top. Am I in the right market stage? Do my moving averages move in the right direction? Yep, done. This is the potential for a very, very simple, entry methodology into a trade. Okay, so am I in the right buy zone? So now it's got to be between my 1 Keltner up here and my 1 Keltner at the bottom. Am I in the zone? Pretty much. This is an 80% probability cone of expiry. So it gives me a forecasted price range at 80% probability for the future. So I know there's an 80% probability that this stock, WDC, is going to be between 76 and 66 on the expiry on the 16th. So if I'm looking to do a bull put spread and I want it to expire at the end of this week and I want to have a probability of winning greater than 80%, it needs to be below $66 on the short strike. So you see what happens is now all of a sudden you filter down this information into this very simple, this is the step-by-step process that I follow. And this can be more complicated. So I know that you've seen the...
You have a lot of indicators, and I know that you use a lot, but you're saying that you don't absolutely have to. It's just something, these like
absolutely
confirmation.
Yeah, I don't think that you need to have a jewelry store. Like I think sometimes for me, when I look at my charts, I'm like, my God, I got so much stuff on this thing. I can't even work out what's going on. It looks like an absolute spaghetti mess. And there are often days where I'll sort of, cut it right down, right? So today, like I looked at my charts yesterday and I was like, there's too much information here. I'll pull up a few. If we look at a couple, let's have a look at some Fibonacci stuff I was doing on Amazon. You'll get to see there's a lot more indicators that I would use on these trades. You can see at the top as well, I've got a lot more. You don't need it. You can simplify this really down to, if I'm just going to be focusing on the Keltner channels, here it is. That's it. You could have it as simple as this or as complicated as you want. There is so much information out there. 20 years ago, when I first started trading, none of this was available. None of this, which made the books the only source of information that you had, which probably was a bad thing in one way because we couldn't really validate any of that book stuff until we actually started trading, number one. Now, at least we've got back testing capability that's within our, it's within our access. So we've got ways we can prove things. And what I would say to people is keep things simple. All right. Don't create a trade plan that becomes overtly complicated because you won't follow the rules. The more complicated it is, the more difficult it is to follow.
You won't find a trade. I've noticed that if the more things that have to line up in your rule set, the less potential trades there are, which may be a good thing, but maybe you'll never actually trade. You'll never actually place a trade if everything.
If you become too dogmatic about for example, give me a second. I'm just going to pull up my scorecard. Yeah, here it is. Sorry. So if I pull up my scorecard, these become complex, right?
Right.
Now, considering the volume of trades that I do, which is around 40 a week, 40 in and out, it can be quite a lot of work, right? But this is very quick. I rate, a 15% weighting on market condition. Market condition is dictated by that indicator right there. Is it green, yellow, or red? It's very quick to see that it's green, scores its points. I don't overweight this though. And this is, I think, where a lot of people get complex, is that if you're doing things just, is it green, is it green, is it green, and then moving on, what's really driving that decision? Which indicator really got you to do that decision? And how much of an importance is it? So I weight them, market condition, price trigger, squeeze, momentum, and then the technicalities. And I look at that and I give them all a point score it out. And at the end of the day, which trade would I do first, W day or Roku? And based on the same weighting, the W day trade, sorry, that's a W day trade. The W day trade that I have scores 10 points higher. So, it allows you, if you were let's say you're a trader and you get 20 opportunities a day, and those opportunities, you sort of apply them at, intervals. Let's say every 3 hours, you look at what you've got, compare, and then you choose one. If you're just trading as your identified opportunity comes in, and then at the end of the day, you stack them all up, you might land up doing 80% of your trades being low scoring trades. And the one trade that you should have really just focused on, the high scoring one, you didn't do because you ran out of money. It's that kind of principle, right? It's like, don't chase things. I often say to my guys, just don't chase stuff. If you feel that the price is a little bit too high, just don't buy it. Wait for a day, come back tomorrow and see if the price is better. And 9 times out of 10, particularly with the way that I trade, 9 times out of 10, the next day is a better price. So when I send a note to my clients, the clients know I'm already in the trade. Now the client can either get into the trade at a price lower than mine, they could wait, they could buy a little higher, it's up to them. But that's a really important thing, is don't chase things.
You want people to filter the ideas that you're giving them through their own rule sets.
Absolutely. So some of my clients, what they do is they go, well, if Chris has sent me something and it's a 90, they understand the level of detail that I've gone to in assessing the trade. So, and why it would score a 90. They know that I have an emphasized, indicator A or market condition B. They know that I've got this weighting system in place. So if it scores a 90, and they know historically that the 90 scored trades of mine tend to be really successful, they know that they could add one more filter on for themselves, whatever it could be, RSI, MACD, whatever it is. They could take my 90 trade, run it through their 4-screen simple process, and then do the trade if it meets their score. That's the ideal scenario you want to be in, because you've got a very detailed pre-screening process, and then your own. It's your own that really makes the juice.
So I know that we have to kind of cut it short because you've got a meeting, but can you talk about the sector? You were talking about something yesterday about the sector that that's coming up, like is it XLI?
Oh yeah. So we're approaching the when you look at seasonality of things, right? So one of the things I really believe in is you've got to have an appreciation for how sectors move at different times of the year, right? So if we look at industrials, if we look at the last 10 years, and we go April, May to July, right? We've got the sort of rising trend of industrials that move up in price over that period of time, right? Over the last 10 years. If we drag this out to 20, you can see that May, June, July, it's not good in June over 20 years, but you've got the strong month in July, right? So you could imagine the graph of this going down and then up. If we start doing our trades and positioning them here for exit there, understanding we may have this down in June, you want to do a trade from here to here, get out, and then in the middle of June, you go back in, right? So XLI is one. XLV, if you look at the last, let's just keep it consistent and go over 20 years, you could see XLV, a rising sort of experience here for April and May. So we're long in healthcare, we're long in industrials. If you look at gold, I don't know if it will show the index. No, it won't show this index, but if you just take GLD, which would be a proxy for it, you go over 20 years, you can see May, June, July, this sort of rising probability of improving price for gold, right? So you want to be going long in gold somewhere in May with the intention of getting out in August. It's a really, really simple thing. So what I do is I look at these seasonalities, And then you go into the index itself. What you'll do is you'll look at the rotational graph that you get here. So let's just take XLI, for example. And if we go into the members of XLI, and what I like to do is a 14-day rolling graph.
I
Now,
really found this graph this graphing system really interesting. I've been playing around with it a lot and locating some.
Yeah, and the thing is, it looks like a bit of a mess when you look at that, right? But just scroll down a little bit, and you'll see these are the top rated stocks, right? So these are the ones already moving into the green box. What you should be looking at is opportunities here in the blue or the yellows, right? So these are where the opportunities are lying. Yellow moving to blue, blue moving to green, right? So if we look, let's just pick out one. So GE, I know we've already got a trade on GE at the moment. So here's GE, right? And if we just look at the graph, we can see it's in the buy zone. I have one buy signal. It's above my Keltner channels. It's not trading at a high price. This is the daily chart. So I'm not seeing it at an extended level. All right. And my squeeze, look at this. I've had a squeeze building since the 24th of March, slingshots around. It starts moving to the upside on the histogram, but it hasn't released yet. All right. So I've still got all this pressure building up. That's the trade. This is where we want to go. And then there's an 80% probability it's going to be between 12 and 14, right? So if I'm looking to do a call spread for income, I want to be above the 1434, sell over here. And if I want to do a put spread, I want to be below this one for an 80% probability. So these are just simple tricks that you have available to yourself, but it's all about a process, right? So then we would take that and put it through the same scorecard and see where the trade comes out. So it becomes very mechanical, and it's not about being emotional about, oh, I don't like GE, or, I don't want to do this because I don't like Lockheed Martin or whatever. You see the opportunity as it's presented and you trade it accordingly, right? So in this one, we wouldn't be selling any put spreads or credit spreads on this trade because the IV percentile is below 50. So when it's below 50, we buy long calls or we buy a debit spread. So we would be looking to do a debit spread. We should be looking to have a price target somewhere, somewhere just underneath that 16.12 if we're going to be doing a next month expiry, somewhere over here. Buy this strike, sell that strike, let it ride. Keep the trend, right? You want to be trading that trend.
I'm actually in this trade. I've got.
Oh yeah.
I did the back for the run, the earnings run.
Cool. Cool.
But is this a stock that I know you don't like to hold through earnings? Would you normally get out before earnings?
Yeah. So let's say the earnings are on. Here's the earnings, right? So earnings we have. I just want to see. Okay, so earnings are on the 27th, right? So we've still got another 2 weeks on the trade. I would be planning to get out of this around the 25th, 26th.
You were saying that there's like a kind of a window of 10 days before and 10 days after earnings.
Yeah, most people. So the theory goes is that in the 10 days before earnings, particularly for second quarter, you'll have these sort of runs into earnings if the stocks have been hammered before. So you'll see stocks sort of breaking out into these new highs. So March was pretty bad for a lot of stocks, right? Particularly on the tech side. So you want to be getting into these trades maybe a little bit before the 10-day spot, and you want to be holding it through that 10-day spot on condition that that the stock itself has rallied before into earnings, right? So you have to be able to look at the graphs and see the previous earning periods and see what happens to the stocks, right? So here on the previous earnings, there was the earnings, you could see it running up and then falling down, right? So you don't want to be holding into earnings. You don't want to be holding it through the earnings announcement. That to me is a crapshoot. The chances of you winning on a deal on the earnings, even when stocks are overperforming, they tend to get hammered. So be careful about just assuming that holding through earnings is safe. It's not. I would rather you got out and then go back into it after the 10 days after earnings. So
yeah, Chris, I know it's 9 o'clock. I just want to let you go, but we'll talk about earnings a little bit more because we still got some stuff coming up the next week.
Yep.
Anyway, appreciate your time.
Thank you, my
Have an
friend.
awesome day.
Yeah, excellent. And I'll get in touch with you later about that email that you sent me as well.
Okay, perfect.
All right, buddy. Take it easy.
Take care.
Cheers, mate. Bye.